After a volatile week in the stock market, we'll be covering a topic we're all interested in, the way forward. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In the slides that follow, we'll be covering some powerful concepts that will help us navigate between point A and point B, reduce trading frequency between point A and point B, and enhance returns between point A and point B. We'll start with a quick recap, then focus on what's worked well, a source of some recent frustration, and a simple and powerful adjustment to address this source of frustration. And along the way, we'll explain the rationale behind this week's trades or opportunity cost swaps. Viewing these two charts here, we know from past videos that this is the favorable look. This is our full bore bullish look with blue, the fastest moving average on top, and our slowest moving average, in this case, on the bottom. This is our full bore bearish look with the fastest moving average blue on the bottom, and the slopes of all of the moving averages are down. These are generic and for illustrative purposes only daily moving averages. Therefore, from past videos, we know this is a favorable look. This is an unfavorable look. This is something that I probably would want to own. This is something I might want to avoid. Similar situation here. If I showed you these two charts on a test and said, which one would you prefer to buy from a probability perspective, you would most likely pick this chart here over this chart here. These particular charts are dated January 31st, 2017, and they cover the U.S. election where this arrow is all the way up here. You can see here's the U.S. election. Transportation stocks look like they were starting a new long-term trend versus the S&P 500. And this chart here shows us the trends near the election for XLK technology relative to transportation. Similar situation here. Here's the U.S. election. You can see banks, KRE, starting a new positive trend relative to the S&P 500. And if we compared the same ETF to emerging markets, we can see this chart near and after the U.S. election, from a trend perspective, clearly favored KRE over EEM. Thus, based on the evidence in hand near the election, it's relatively easy to see the winners relative to these battles: transportation and banks. We'll run through a few of these. It'll help us understand where we were and how we got to the present day: favorable, unfavorable, favorable, full bore bullish, full bore bearish. U.S. election. Here you can see small cap value is trending in a positive manner, and the trend appears to get stronger here relative to the S&P 500 near the U.S. election. And if I compared IWN, small cap value, to India at the same time, you can see the trend clearly favored small cap value. Similar situation here. This is SP high beta near the election relative to the stock market. And if we compared SP high beta to emerging markets at the same time, it's pretty clear to see from a trend perspective which way the probabilities are leaning. On the left side, the facts in hand favored small cap value, and on the right side, they favored high beta. Favorable look, unfavorable look. Favorable look, unfavorable look. What charts are we looking at? U.S. election here, U.S. election here. This is base metal stocks relative to the S&P 500. Europe relative to base metals. Value stocks, VTV, turning up relative to SPY, and growth versus value after the U.S. election. It appears that we have a consolidation here with our trends and a bearish breakdown against growth. This chart is dated December 1st, 2016. And if you're a client, you know that we were making decisions based on the look of the charts here. For the most part, we started buying the Monday before the election and then feathered money in quickly the day of the election and after the election. In these examples, the facts in hand favored XME, metals, and VTV value over SPY, and also over VUG growth. We'll review one more set with our favorable looking charts on the top and our unfavorable charts from a probability perspective on the bottom. These charts are dated December 1st, 2016. Here's the look, the U.S. election. These are dated December 23rd, 2016. The U.S. election is here. Russia versus the S&P 500. Emerging markets relative to Russia. Germany relative to mid-caps. And mid-caps, IJH, relative to the S&P 500. Facts in hand after the election favored Russia on the left side and mid-caps on the right side. If the model's objective is to find ETFs that have a high probability of outperforming the S&P 500 and to find ETFs that are in existing uptrends, how effective were the previous charts or the basic selection process, and how effective was our execution? To answer that question, we're going to look at the performance of SPY relative to these ETFs here from November 8th to February 10th, 2017, and see how these ETFs performed relative to the S&P 500. The S&P 500 here is in red. We have transportation stocks, banks, small cap value, SP high beta, metal stocks, value stocks, Russia, and mid-cap. You can see between November 8th and February 10th, 2017, every single one of these ETFs outperformed SPY, and some of them outperformed by a wide margin. The bigger picture macro charts and the model also told us to be open to buying in this area here. Looking at this chart here, this obviously is not the source of our recent frustration. And if you follow the markets closely, for the most part, these ETFs are tied to the so-called Trump trade. And a lot of this outperformance here is based on the expectations that we might see something like tax reform, some easing on Glass-Steagall, etc. We all know the events in Washington that have occurred in recent weeks and recent months. And some of that was an indirect cause of the source of our frustration. But the real source of our frustration was looking out the next 66 days. It's like a mirror image. Instead of all of these ETFs outperforming SPY, every single one of them underperformed SPY. And from a strategy perspective, one of the reasons why you diversify across so many ETFs at this point here is you understand that some of the policies of the Trump administration under any circumstances probably aren't going to make it through, and therefore some of these ideas based on anticipated policies are not going to work, and typically some of them would. As you can see recently, in this case, that idea of diversifying has not helped. This is relatively rare here that we would see a flip like that across so many ETFs, but it's relatively easy to understand how it happened. Remember, when we're looking at these charts here, we're holding these ETFs. So we've made our decision to buy most of them back here near the election, and we just looked at the charts there. We always talk about maintaining maximum flexibility in these videos, and obviously something changed and the market reacted to it. Fair question might be, did the evidence say the primary trends had changed in these ETFs? The answer to that question is also a little bit of our source of frustration. We're tracking charts like this from all different angles for all of our positions, but the answer to this question is and was pretty much no all the way across the board. This is IWN, small cap value. This is the election here. You're buying thinking a new trend or another leg has started here at the election. And as of May 18th, 2017, the right side of the chart here looks like a normal retracement within the context of an ongoing and existing uptrend. You bought here thinking a new uptrend was in place or the existing trend would continue. You really don't have a yellow or red flag over here relative to the retracement. And the situation is very, very similar across many of the ETFs. SP High Beta. Transportation on May 18th had come back to the 50% retracement. Banks, KRE, this still looks like a normal retracement relative to the fibs. When we see a graph like this, it's very, very logical to ask, is there a better way, or is there something that we can be doing differently going forward to reduce the probability of something like this occurring again? To start answering that question, let's go back to this NYSE monthly chart that we covered in late January 2017 when we talked about 17 years of consolidation being followed by very healthy gains. And we pointed out the similarities between this orange box and this orange box that dated back to 1997. You might remember in that video we asked the question, was there anything that we could do to help increase the probability of successfully navigating between point A and point B? The answer is yes. Trend following techniques during this entire rally here, for the most part, the slope of the 50-month moving average remained positive. And we know from the topics we covered in the past 2 weekly videos that in the present day, 2016, 2017, there are a lot of similarities to this look here in 1995. And we even presented some arguments that said it's in the realm of possibility that the present day might have a better setup than 1995. The longer a market goes sideways, the bigger the move that we can expect to get. It's possible in the present day we're going to see strong trends that could literally last for years. And we know that we don't have to do a lot of trading to capture excellent returns here. These are returns after January 1st, 1995. Therefore, if the present day looks anything like this period here, we want to own things that will enable us to stay invested for the most part between point A and point B and give us a high probability of having a relatively low trading frequency. Therefore, in the present day, we really want to own things that look like this. Getting back to, is there anything we can do to improve our probabilities? A logical question to ask after something like this is, are there discernible differences between the ETFs that underperformed relative to the holdings that performed well? And the answer to that question should help us improve our probability of success. There's several things that we have to do well to navigate between point A and point B. Let's shift gears to some things that have gone well. General market direction. The charts in the spring of 2016 started to improve, and in August, we had that rare signal that told us to keep an open mind about good things happening after the election. And from a market direction perspective, the facts that we had in hand told us to be ready to move before, during, and after the election, something that paid dividends relatively quickly. In terms of the discernible differences between the underperformers and those ETFs that performed well, here are a couple of examples. We're still holding an SPY position from May of last year that's up about 13 or 14%. We also have a scale-in position along the way in VTI that's up over 9%, meaning these ETFs helped us successfully leverage the models and hard data's take on market direction. It's important to note that these figures here were achieved with 0 trades after our entry point, which is pretty much what we want. All things being equal, we'd prefer to reduce trading frequency, and we prefer to reduce it even further. We've added a new and relatively simple screen to the front end of our process, and if we walk through some charts here, it'll be relatively easy to understand one of the major concepts behind that screen. Looking at this chart here, we know this is a favorable look. This is an 8-year base and a bullish breakout. These are monthly charts. As we get the bullish breakout here, the 50-month moving average turns up. On the other end of the spectrum, this is an unfavorable look from a probability perspective. The chart on the left is technology relative to the S&P 500, and the chart on the right is European stocks, FEZ, in the ETF world, relative to the S&P 500. Let's dig a little deeper into these concepts here on the right side of the screen. This is our long-term monthly chart of emerging markets EEM relative to SPY. This chart is dated May 18, 2017. This is an extremely easy to understand and extremely important concept. If we understand it and use it in our screens, we can make sure that we're focusing on the highest probability ETFs. What can we learn from this chart? This ratio peaks in 2010 and then it turns against emerging markets. This long-term trend from 2010 into 2016 tells us that the probability of being an EEM was unfavorable relative to the probability of being an SPY. Think of how many times investors bought EEM here with the hope of outperforming SPY. A new trend is starting here. EEM will help me outperform SPY. A new trend has started here, and thus EEM is going to help me outperform SPY. This is where market fractals come into play. A new trend has started here, but it's a counter trend within an existing downtrend. One of the best ways to discern between two ETFs, if you're a little bit confused, is to keep moving out to longer time frames. If we buy EEM here with the hope of outperforming SPY, we're betting that this downtrend will change. We're betting here that the existing downtrend, the facts in hand, will reverse. So a logical part of the screening process would be to look for ETFs that are already trending relative to the S&P 500. Nothing has to change here for VGT in order for VGT to outperform SPY. If this trend remains intact, from a long-term perspective, this ratio would continue to make a series of higher highs and higher lows. And as we dug a little bit deeper into this, it became interesting. How many of the 243 ETFs tracked by the CCM ETF scoring system currently pass the new screen? The answer is less than 60 or 25% roughly of the 243. So what that tells you is 75% of these ETFs here, for the most part, have the odds stacked against them if you're buying them in the hopes of outperforming the S&P 500. I don't want to get too down on emerging markets because they do score very well in the model, and this is a constructive look here. So how would you handle that at the early stages of a new trend? It's relatively simple. You do it with position size. So if we take a position in a lower probability ETF like EEM, the way we handle this is we just take a very, very small prove it to me position. So we manage this risk with position size. Emerging markets is only 0.5% of my portfolio. Even if it loses 100% of its value, I only lose 0.5% relative to my account size. If we take a ridiculously small trade here and EEM continues to outperform, we can always add to it. Conversely, if this downtrend continues, we haven't put a lot of our capital in harm's way relative to a lower probability opportunity. Constructive look here, turning up, price above. Lower probability look on the right. Both charts dated May 19th, 2017. This is growth stocks relative to the S&P 500. This is a favorable look from a long-term perspective. And this is India EPI, which also scores well on the model. And this is somewhat of a constructive look here. But this hasn't turned yet relative to technology. And this move here hasn't proven yet that it looks anything other than a normal counter trend within the context of an existing downtrend. But once again, this is somewhat of a constructive look here, so you have to keep an open mind. Constructive look, unfavorable look. On the left, we have a 12-year base, a bullish breakout. The 50-month moving average is turning up in a bullish manner, and that coincides with the breakout from the 12-year base. Left side, semiconductors relative to the S&P 500. It's a good time to note that the screens that we've added do not necessarily screen out higher volatility ETFs. In the present day, semiconductors passes that first screen. Chart here will help us understand why we made some of the chess moves that we made. This is mid-cap stocks. We sold and locked down a profit in our mid-cap position this week. Here's the look of the chart relative to the S&P 500 on May 19th. It's not a very constructive look. Mid-caps looked like they were turning. We're zooming in here. The ratio moves above the 50-month moving average, and it's turning up in a bullish manner. This is December 9th. If we fast forward to May 19th, now this looks like a failed bullish breakout, and the moving average is rolling back over. Often when you fail near a downward sloping trend line, bad things happen. It doesn't mean bad things are going to happen, but if this remains in place, mid-caps, from a probability perspective, seem to be on track right now to underperform the S&P 500. Obviously, this is subject to change, but this is the chart that we have in front of us now. Favorable look, unfavorable look. This is internet stocks relative to the S&P 500. This is materials, FXZ. Nailed down a profit in this week, and this is one of the reasons why. In January of this year, this is a constructive look. It looks like we're trying to start a new long-term trend in favor of materials. If we fast forward to the present day, this also looks like what might end up being a failed breakout. Instead of having a constructive look, this is a concerning look. We can find better places for our capital. If this move continues here, it doesn't mean IWN has to go down. It just means IWN, if this trend continues this way, would underperform SPY. Based on what we know today, every ETF that we swapped out this week, the odds are that every single one of them will move higher. But the odds are also pointing towards continued underperformance. Favorable look, price above an upward sloping moving average. This is a dicey look. This looks like a failure near a flattish and now rolling over 50-month moving average. May 19th, May 19th. This is QQQ Tech versus the S&P 500. This failed breakout look is SP high beta relative to the S&P 500. This is May 19th. On December 8th of last year, this is a constructive look. If this look remains in place, this is a relatively scary look. Doesn't mean SP high beta can't go up if this continues, but it would underperform. These charts can help us summarize the rationale for the chess moves this week. This is growth versus value daily, weekly, monthly charts. We're just using generic and for illustrative purposes only moving averages. If we looked at all of these charts in February of this year, every single one of them was still favoring value over growth. And if we fast forward to May 18th, 2017, you can see now the daily, weekly, and monthly from a probability perspective are favoring growth over value. A few weeks ago, we covered the reasons for selling. Our chess moves this week have nothing to do with being bearish or being overly concerned about the long-term trends in the market. We really didn't have evidence of a trend change. These are opportunity cost analysis-based moves where we're looking at improving our probabilities of success and reducing the probability of underperformance. Our moves this week might seem counterintuitive to the concept of making 533% with zero trades between point A and point B. But the moves that we made this week, if they improve the probability of a long-term uptrend remaining intact or a long-term period of outperformance remaining intact, and they reduce the probability of a reversal, these moves are 100% in alignment with the concepts of trying to move more efficiently from point A to point B. Remember earlier in the video, we said these gains here were captured with zero trades. The screens that we have added force us to focus on ETFs that have similar characteristics. The new screens will allow us to focus on a much smaller subset of ETFs going forward. There's a handful of things that we have to do well to navigate from point A to point B and capture a gain like this that can occur over a number of years. The model and the evidence has done a good job helping us with market direction. The outperformance in the weeks after the election show us there's nothing wrong with our ETF selection process. Our implementation has been extremely sound, and we've got a very, very good handle on the discipline required to navigate from point A to point B. The area where we can improve is to filter out some of the lower probability ETFs before we go into our formal ETF selection process. It may not be an overstatement to refer to this screening process as a watershed moment. We're extremely confident that these screens will improve our probability of successfully navigating between point A and point B. Screens should reduce frustration and improve performance. It might be helpful to look at one example of the present day trends relative to this long-term look here between 1995 and into calendar year 1999. As of May 19th, 2017, the same for illustrative purposes only moving averages, we still have a full-bore bullish look, and this looks like a strong trend from a long-term perspective. From a short-term and very short-term perspective, there are some concerns, and that's why we've kept some powder dry. It's possible that the market will move back in this direction before it moves back in this direction, even if these trends remain intact. Even if that happens, we'll enter next week in a much better position to handle a pullback than we did the previous week. In terms of our redeployment strategy, we're somewhat fence-sitting here. We've redeployed roughly half of that capital, the thought process being it's possible if we move in this direction, then the dry powder will be a good thing. We really don't have to clear that many more hurdles to redeploy the remaining capital. So if the market can prove some things, we will redeploy the remaining cash relatively quickly. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.